Let me hit you with a number that should stop you cold. 90%. That's the share of trade between Russia and China, now settled completely outside the US dollar. Not half. Not most. 90%. And if you think that's just a foreign policy headline with no bearing on your paycheck, your mortgage, or your retirement savings, you need to watch every second of this video. Because what's quietly unfolding right now in global energy markets is the single most consequential financial shift since Bretton Woods, and almost nobody in mainstream media is covering it. I'm a finance professional with 2 decades of experience tracking macroeconomic cycles, and I can tell you with full confidence, the petrodollar system, the invisible architecture that has quietly underwritten American prosperity for 50 years, is being systematically dismantled. Not overnight. Not in one dramatic crash, but piece by piece, deal by deal, in a slow and calculated bleed that is already affecting your cost of living. Stay with me. To understand what's breaking, you first have to understand what was built. Back in the early 1970s, the United States struck a landmark deal with Saudi Arabia. The arrangement was elegantly simple. Saudi Arabia would price its oil exclusively in US dollars. In return, America would provide military security and political backing to the kingdom. Other OPEC nations followed suit, and just like that, a new global financial architecture was born, the petrodollar system. Here's why that deal was so powerful for everyday Americans. Because every nation on Earth needed oil to run its economy. Every nation on Earth was forced to hold US dollars. You can't buy crude oil without dollars. That meant countries from Germany to Japan to Brazil were constantly stockpiling American currency, not because they loved the US, but because they had no other choice. And what did those countries do with all those dollars? They recycled them back into US Treasury bonds. Foreign governments became the primary buyers of American debt. That flood of foreign capital into our bond markets artificially suppressed interest rates for decades. Cheap mortgages, cheap car loans, cheap business credit. The affordable middle-class lifestyle that defined 20th century America was in large part quietly subsidized by this petrodollar recycling mechanism. Now ask yourself, what happens when that mechanism stops working? Here's the headline that should have been everywhere, but wasn't. Saudi Arabia allowed its 50-year exclusive petrodollar agreement with the United States to expire without renewal. That agreement, the foundational deal that locked global oil into dollar pricing, quietly ended. No fanfare, no emergency press conference from the Fed, no breathless CNN segment, just silence. And in that silence, something enormous shifted. Saudi Arabia has since publicly signaled its willingness to accept alternative currencies for oil exports. They've joined a groundbreaking cross-border digital payment project called mBridge, a blockchain-based currency settlement platform developed with support from the Bank for International Settlements. mBridge is specifically engineered to conduct massive international transactions completely outside of SWIFT, the Western-controlled financial messaging system that the US has historically used to enforce sanctions. Let that sink in. The country whose oil deal gave the dollar its global status is now actively building the infrastructure to settle trades without it. This isn't theoretical. This isn't alarmism. This is documented policy. And it's only one piece of a much larger puzzle. Here's where the story gets bigger and more dangerous. The BRICS economic bloc, originally comprising Brazil, Russia, India, China, and South Africa, recently underwent a dramatic expansion. New members include Saudi Arabia and the United Arab Emirates. Think about what that means structurally. You now have the world's largest oil exporters sitting at the same table as the world's largest and fastest-growing oil consumers. Sellers and buyers in one alliance. When that happens, the middleman becomes obsolete. And for the past 50 years, The US dollar was that mandatory middleman for every single barrel of oil traded on the planet. This expanded bloc, what analysts are starting to call Petro-BRICS, controls an overwhelming share of global daily crude production. They represent the largest growing base of energy consumers on Earth. They possess the majority of the world's proven fossil fuel reserves, and increasingly, they're trading among themselves in their own currencies. Russia and China are settling hundreds of billions of dollars in bilateral trade using rubles and yuan. India is purchasing discounted Russian crude oil and paying in rupees. The UAE has facilitated massive energy deals with India denominated in local currency. China launched yuan-denominated oil futures contracts on the Shanghai International Energy Exchange, creating an alternative pricing benchmark that bypasses London and New York entirely. Every barrel of oil sold outside the dollar is one less reason for a foreign government to hold dollar reserves, and one less reason to buy American Treasury bonds. You might be wondering, why now? The dollar has been dominant for a century. What changed? 2 words: frozen reserves. In 2022, the U.S. government froze approximately $300 billion in Russian sovereign assets, foreign currency reserves that Russia had legally accumulated and deposited in Western financial institutions. It was an unprecedented act of financial warfare. And while you may agree or disagree with the policy decision, the geopolitical consequence was immediate and severe. Every central bank on the planet got the same message at the same time. Your dollar reserves can be confiscated if Washington decides it doesn't like your foreign policy. The dollar, long considered the world's neutral reserve currency, safe, liquid, politically untouchable, revealed itself as a financial weapon. Trust is the bedrock of any reserve currency. Once broken, it's nearly impossible to rebuild. And right now, sovereign nations across the global south are racing to reduce their exposure to a currency that their governments can no longer trust unconditionally. This is why we're seeing record-breaking physical gold purchases by central banks globally. Over 1,000 metric tons per year, the highest sustained buying pace in 70 years. Gold cannot be frozen. Gold cannot be deleted from a server in Brussels or New York. It is the ultimate neutral asset, and it is quietly becoming the foundational collateral for the new financial architecture that Petro-BRICS is constructing. China has simultaneously slashed its U.S. Treasury holdings to the lowest levels in decades. The capital extracted from those bond sales has been rotated directly into physical gold. The People's Bank of China is not subtle about what it's doing. They are building a parallel reserve system that does not depend on American goodwill. There's one more dimension to this story that almost nobody is connecting. The global energy transition itself is undermining the petrodollar's structural foundation. The original petrodollar deal worked because fossil fuels were non-negotiable. Every economy needed oil. But as solar, wind, and battery technologies mature, the global dependence on crude oil is beginning, slowly but meaningfully, to shift. The new critical commodities are lithium, cobalt, copper, and rare earth elements. These are the materials that power electric vehicles, solar panels, and grid-scale battery storage. And here's the crucial point. These commodities are not priced in dollars. Their supply chains run through nations aligned with BRICS. China dominates global processing capacity for virtually every critical green mineral. They're not waiting for the West to build alternative infrastructure. They're establishing their own commodity exchanges. They're creating pricing benchmarks in yuan. They're building the financial plumbing for a world where powering your country's electric grid doesn't require a single American dollar. This means the petrodollar's successor, whatever we might call it, may not be an American system at all. The country that controls the energy of the 21st century sets the terms. And right now, the United States does not control those supply chains. Let me be direct. The goal of this channel is never to generate fear. It's to generate awareness, and awareness generates action. Here's how to think about protecting yourself. First, understand that traditional portfolio assumptions are breaking down. The classic 60-40 stock and bond portfolio was designed for a stable, unipolar world with low inflation and falling interest rates. That world is ending. Bonds face structural headwinds as foreign buyers retreat. Stock valuations that assumed perpetual cheap capital and globalized profit margins are vulnerable to repricing. Second, hard assets deserve a genuine allocation in your portfolio. Physical precious metals, gold and silver held outside the banking system, serve as insurance against currency debasement. Central banks aren't buying gold paper contracts, they're buying bars. That distinction matters. Silver, in particular, presents a compelling asymmetric opportunity, given its irreplaceable industrial role in solar manufacturing and the mathematical supply constraints that entails. Third, if you own real estate with long-term fixed-rate debt, understand that inflation actually works in your favor. The nominal value of your property rises with inflation, while the real cost of your mortgage shrinks. That's a wealth transfer mechanism, legal, time-tested, and available to ordinary Americans willing to use it wisely. Variable rate debt, on the other hand, is increasingly dangerous in a high-rate environment. Eliminate it aggressively. Fourth, examine your equity holdings for geopolitical vulnerability. Companies heavily reliant on foreign manufacturing, Chinese supply chains, or global logistics networks face compounding risks from tariffs, export controls, and supply chain fragmentation. Shift emphasis toward domestic producers with pricing power and localized supply chains. Fifth, eliminate high-interest consumer debt. Credit cards and auto loans at 20% plus are silent wealth destroyers in any environment. They become catastrophic in a period of structural inflation. Finally, stay informed. The mainstream financial media is not covering this story adequately. They have institutional incentives to maintain public confidence in the existing system. Your job is to track the macro data yourself. Central bank gold purchases, Treasury foreign holdings, bilateral trade agreements, BRICS summit outcomes. Watch what sovereign actors do, not what politicians say. Here's the bottom line. The petrodollar system that quietly subsidized American living standards for 5 decades is structurally failing. Saudi Arabia's decision to let the exclusive agreement expire is not a footnote. It's the headline of the decade. The Petro-BRICS alliance is real, it's growing, and it's deliberately constructing a parallel financial world that operates independently of Washington. This is not a call to panic, it's a call to prepare. The people who understand this transition early, who reposition their assets, eliminate their debt vulnerabilities, and acquire tangible stores of value, will not only survive this shift, they'll build generational wealth from it. We are witnessing the conclusion of a 100-year monetary cycle. History shows these transitions are messy, inflationary, and full of opportunity for the informed. Don't let willful ignorance cost your family their financial future. Hit subscribe so you never miss an update. Drop a comment below and tell me how you're positioning for this transition. And share this video, because the algorithm won't push content that challenges the mainstream financial narrative. You have to do it manually. I'll see you in the next one.